Andrew, thank you. We're pleased to be joined this morning by Neel Kashkari, the Minneapolis Federal Reserve President. Neel, thanks for joining us, and I can't think of anybody better to be here because of your experience both at the Minneapolis Fed over many years, but also from investment banking, as well as your role in the Treasury during a particularly interesting time, the great financial crisis. So, Neel, I usually don't do it this way, but I just want to ask you broadly, how are you feeling about the economy right now and financial markets, given all of the changes that are going on? I'm going to ask you the most open-ended question I've ever asked a Federal Reserve official.
Well, good to see you. Thanks for having me. It's hard to get a read of what's happening underneath. You know, it's really important for the Fed. Obviously, we're very focused on inflation and employment, trying to understand we've got an uptick in inflation expectations in the near term. It's our jobs to make sure that that does not translate into a long-term increase in inflation expectations. And so I'm paying attention to the same market moves you all are. The bond market, I'm paying particular attention to try to understand what is it telling us about the underlying inflationary dynamics. And it's a complicated thing to analyze.
Before you get to the inflationary dynamic of the bond market, Neel, one of the remarkable developments has been this, that at a time when there's concern across the globe, the general trade has been to trade into U.S. assets as a flight to safety. That's not happening now. The dollar is selling off this morning against a broad range of currencies. Yields have been elevated. Is it curious to you, and what is it telling you, that there is no obvious or traditional flight to safety in the current environment?
Yeah, I think your observation goes to the heart of the matter, and I always go back to fundamentals. Why do we have a trade deficit in America for decades? It's because this is just the math of economics. Investors around the world have viewed America as the best place to invest. And if that's true, we will have a trade deficit. And so now one of the ways that expresses itself is in lower yields across asset classes in America. So if the trade deficit's going to go down, it could be that investors are saying, OK, America no longer is the most attractive place in the world to invest. And then you would expect to see bond yields go up. Now, it also could be inflation, and that's why this matters a lot to the Fed. I'm not seeing evidence yet that long-run inflation expectations are climbing, and it's the Fed's job to make sure that that doesn't happen. But I would expect to see, if investors decide, hey, we want to invest elsewhere, all else equal, that ought to be pushing up yields, and you'd see that in what we call the term premium.
Neel, can I just throw one other possibility on that? These are pretty short-term moves. We hope they don't become longer-term moves. Could it be a reflection of hedge funds and others that were leveraged and needed to sell things as equity markets dropped, selling the assets that are most liquid and trying to make sure that they have the cash to pay whatever comes?
Certainly, there's a lot of, you're right, Becky, there's a lot of complexity. The basis trade has been getting a lot of attention. But I would just point to something that Steve mentioned, which I think reinforces the story a little bit, and that is that the dollar has been weakening. Normally, when you see big tariff increases, I would have expected the dollar to go up. The fact that the dollar is going down at the same time, I think, lends some more credibility to the story of investor preferences shifting.